Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I'm your host, Dominic Chu. Thematic ETFs are back in vogue. Maybe they were never out of vogue. Of course, the first thought is AI, but is now the time to look beyond that singular headline or theme. Joining me now is Nico Lacqua, the CEO of Corgi, along with John Davi, the founder and CEO and CIO of Astoria Investment Management, both folks who have some at least experience with the ETF business. Thank you, gentlemen, both for being here with us right now. I love the fact that thematics are very much in focus, because what it means is that the ETF business has evolved to the point where we can be a little bit more specific, a little bit more tailored about the way that we present investment products. So maybe I'll start with you first, Nico, in this conversation. Corgi made a lot of headlines over the course of this last few months with regard to the speed at which you've been able to bring ETF product to market across a number of different themes or different types of investing. How exactly does a company in this day and age use technology, use the evolution of the business to bring product like that to market? It used to take years to go through and get the investment approval done, the regulatory approval done, and now you can bring them to market so quickly. How does that happen?
Well, AI is really the big factor and the big technological shift that's enabled us to do what we're doing. And I guess for context, by the end of the year, we expect to have more ETFs issued than any other issuer. I think number two will be BlackRock at that point. And really our focus is on driving down costs, having the lowest fees typically in whatever category we're in. We normally target about a third to half the expense ratio of most of the other choices, and offering investors, whether that's institutional investors or retail investors, more choices at a lower price point. And the reason why we're able to do that is because we're able to be much more compliant. We're able to file things much more quickly. We're able to operate significantly faster. We're able to come up with ideas faster, because AI really can plug into every single part of the operational business. I mean, filing ETFs and launching product is really a words-based industry, and large language models are very good at using words.
Oh, that's interesting, because, I mean, John, you run ETFs product as well. How has your experience been with regard to kind of the work that you've had to do? You've been a little bit more traditional in the way that you've brought these things to market without the use, at least for right now, of many of those AI tools that Nico refers to. The lead time for you to bring your product to market, what does it kind of compare with what you're seeing happen right now in this business?
Well, I would say it's gotten quicker. I mean, obviously, Corgi has their own approach. They're trying to, issue large amounts of ETFs. On our side, even though the time is shortened considerably, we want to bring life products that we feel like we can use ourselves. So as an asset manager that serves as an OCIO, like if we can build a better mousetrap, and we can, because we're, an active manager, we've got good quants at Astoria, we want to launch when we can solve a need for ourselves. So we want to sort of bring assets to the table upon launch. And I do think that in talking to Corgi, like they do have some version of that, which I found interesting. So yeah, we want to launch products where we think there's a need, there's a vacancy, and we can build a better mousetrap.
Nico, one of the other kind of dynamics at play here is the active versus passive. And that's been the same kind of dual bucket system that we've talked about the ETF business in for decades at this point now. There hadn't been that many actives in the kind of beginning stages. It was much more index-based and passive. Now, much of the growth in terms of number of funds coming to market is being driven by the active management component. How do you treat your funds at Corgi? Are they kind of benchmark-based, based upon some of the indices that you develop? Or do you have, say, portfolio managers that are kind of making active management decisions about the types of stocks, the types of investments that go in and out of your portfolios and funds?
Yeah, so when we think about our portfolio, I guess, of ETFs, even the actively managed ones that we have tend to rebalance around once a quarter along, kind of guidelines that might look a lot like a traditional index fund. So I wouldn't call even our actively managed ETFs that active relatively. The way that I think about it is, and the reason why I think we're seeing a huge growth in the number of actively managed ETFs as opposed to index-based ones, is because from a time to market perspective, it's much faster to launch an active ETF that maintains many of the qualities that a traditional passive one might launch. So in my judgment, kind of the distinction in many ways is blurring, because if you look at some of the active ETFs that even other issuers that aren't Corgi have launched recently, a very good number of them could just as well be done via an index, by tracking an index.
John, one of the kind of points that Nico brings up that's interesting to me is the idea that you can have this kind of active with passive component, this offering, if you will. But there's always going to be this kind of a view that for an actively managed ETF, that there's a team of people or a group of people, portfolio managers, analysts, who are kind of making these decisions to rebalance, whether they be quarterly, semi-annually, yearly, or even more frequently than that. But it also does kind of provide a different type of exposure than an index-based exposure. From your standpoint, these thematic type ETFs, are they better off as actively managed ones or developed by an underlying index or a set of indices that are designed to then track those indices? How do you think that kind of dynamic plays out?
Well, so like specifically right now, I'd say a lot of people trying to copy like DRAM and the success that has brought. So it kind of reminds me of like HUDJ, DXJ in the 2010 period, where WisdomTree launched these currency hedge ETFs because like central banks were trying to weaken their currency. And so like there was hundreds of products that were launched after that. Some were active, some were passive, but really like DXJ and HUDJ sort of stole the show. So now what I find is like all these AI thematic ETFs that are being filed, it's from like, I would say a lot of issuers that effectively at the end of the day, to me, they're like sales marketing companies. They're not real active managers. And I just think if you're going to go specific in one area of like the market, you really need to be like a skilled active manager. So that'd be my vantage point. Like I do personally think there should be like an AI adopters ETF, right? An active manager that's going to say, okay, where within this labyrinth of AI is going to be the most beneficial? To us, that would be like the adopters, like banks, insurance companies. It would be like parts of emerging market. It would be select industrials. So what I find is that like there's a lot of like thematic AI products being filed, but like they're not going to give me really the exposure that I think benefits. So bottom line for me, Dom, is that you got to be an active manager that kind of can skillfully navigate the marketplace, not use an index.
How, Nico, when you have a product offering like yours, kind of split between active funds and passive funds, does that then mean that you have groups of employees dedicated towards the so-called active management, the research that goes into things, the quarterly or so rebalancing that these things go towards? And how exactly does that kind of differ from the teams that you have running and administering the passive products when they're all under one roof, one house for these Corgi ETFs?
Yeah, it's a great question. I mean, I think from our perspective, we're about offering investors choice. Normally, even the names of our ETFs describe what the strategy is. And we tend to not, as a company, structurally endorse particular companies as opposed to others, with regards to whether we think that they have a better approach or a worse approach. So even like if you look at most of our active ETFs, they tend to be more or less market cap weighted. And that's because what we found and most backtests reveal is that a more passive-ish strategy tends to overperform. And that's kind of just our position. Like we do have teams of people that do trading, particularly on fixed income and other areas. And that team is growing quite a bit at Corgi. But as a company, I don't think that our job is to like be a hedge fund or something like that, where we're saying that company A's strategy is better than company B's. We tend to let the market do that by market cap weighting, by offering the lowest fees for all of our thematics. Really, that's our approach, to launch comparable products to very popular thematic ETFs, but at a third to half the expense ratio.
Okay, so the cost is a huge driver because it is something that does attract investors, by the way, because in this day and age, people look towards not just the tax efficiency of some of these ETF wrappers as a structure, but also, most ETF investors will go right away and see, hey, what are the average annual returns for certain sets of periods, and then they'll look at what the fee or the expense ratio is. So that's a big driver of it. When it comes to justification of some of those fees, John, it's also about having a manager who can identify where opportunities are that can justify the fees that they're doing, especially if it's a non-passive strategy, if one where you're paying somebody to outperform a certain benchmark. Where exactly do you see some of those opportunities developing from your standpoint about the types of thematics that you would use to capitalize on things that you think are going to be the next hot topic in the markets?
Well, I would say that so we run a strategy called hedge growth, which basically, the basic premise is like, okay, if the S&P is up 20% a year, we're gonna, sort of target, it's not guaranteed because it's not like an insurance product or a buffer, but we want to sort of target like an 8 to 10% total return. If the S&P is down 20%, we would hope and strive that this thing is going to be down, 6, 7%. So within our model, we'll use buffered ETFs, we'll use actively managed fixed income ETFs. Those are to me, some areas that, you need skillful managers, people that are going to sort of navigate fixed income. To us, the equity side of the picture is clean, generally speaking, rotate away from Mag 7, tilt international, buy value, but fixed income, you need an active manager that can pick and choose credits and, make bets on duration. So those areas, I would say, buffered ETFs, actively managed fixed income, or let's say parts of emerging markets, parts of, select parts of fixed income, you need active managers, and we'd be willing to pay a management fee if they perform well. But I sort of disagree with what Nico said. To me, you should not buy passive ETFs because of low fees. To me, that's why, the Mag 7 is so big in S&P. It's like a self-fulfilling virtuous cycle because S&P is issued at 3 basis points. People just keep buying it, and then it buys the same stocks, and it's this, definition of insanity, let's say. So there, I would rather go, on the equity side, not go passive, pay a higher fee also, and have a manager that's going to tilt away.
Interesting, because Nico, the number of funds that you've brought to market, they are all very low fee on a relative basis to some of their peer funds and peer issuer companies out there. But when you take a look at the reason why people move into some of these funds, it is because they are trying to capitalize on, I guess, an iron is hot situation. They're trying to strike some point there. John had mentioned the DRAM, the round till kind of memory ETF. It kind of was there at just this right moment when everybody was keying on a certain specific part of the market. When you bring product to market, how much of it is driven by your own internal research or your own internal kind of axe to grind about the types of funds you want to bring to market, as opposed to what the investor demand is or where you think investors are willing to kind of put their money into certain types of funds or certain types of themes?
I mean, honestly, most of it's our own internal conviction. If we think something's cool, we'll launch it, whether it's very popular with investors or not. Because if we're launching the lowest fee version of something, we're very patient people. We have infinite time to wait. And if we launch the lowest fee version of something, sure, people can pay 3 times the fees to allocate their capital elsewhere. But over some long time duration, I certainly believe that people will choose the low fee versions. I'll use our buffers, for example. I think market right now for everyone else is 79 to 85 basis points. We launched our buffers at 30 basis points. So sure, you could buy a buffered product at multiples of the expense ratio, but I think you'd be a little silly to do that because a buffer is a buffer. It's the same product, that's kind of our position in general, that we view high fees as unjustified. Corgis are short dogs. We like short fees. So,
but I think, Dom, what your vantage point is, 2 things, right? One is your insurance company, right? So your firm takes in premiums, right? You've got a long pathway for your ETF business to survive. And second is that they can allocate your own internal capital to your own ETFs, right? I mean, that's what's unique compared to a new startup issuer that doesn't have reoccurring premiums that they're collecting that they can allocate. They're trying to find new people, right? I mean, that's why I think Corgi is probably the biggest success story of the year and the most unique, right?
So in response to that, how do you navigate at Astoria a kind of market where there are different types of players with different runways and different types of vantage points or horizons? And does it change at all the competitive dynamic from your mind about how you have to approach investors? Is it just about still returns and fees, or do you find some other value proposition that kind of makes certain firms stand out over others in terms of not just garnering assets, but then keeping them over the longer term?
Well, so I'll give you an example. One is, so again, we were worried about the Mag 7 like 2 years ago. We thought that it was crowded, expensive, vulnerable, valuations are high, and we wanted to sort of tilt away. So we weren't ready to buy value. We didn't necessarily want to go to like, international markets, let's say. So we looked at like the S&P Equal Weight ETF or the Russell 1000, and those are like effectively like value small cap plays, and they're 15% tech. But we're not Corgi, right? We're not going to launch 1,000 ETFs. Like, we're going to launch ETFs that we have an internal use for on our side, and we want to sort of partner with the right advisors that sort of see our vision and would participate with us.
Speaking of internal use, Corgi has an internal use for some of these ETF products. It is one of the big reasons why you are in this ETF business, or one of the catalysts behind you devoting capital towards developing ETF business. Can you take us through what exactly Corgi, as the parent kind of insurance type company, is, and why ETFs are attractive business for you to even be involved in?
Yeah, so at Corgi, our mission is to make insurance faster, make it better, make it cheaper, to waste less of people's time, and to protect people when something goes wrong, to basically make insurance infrastructure, by using AI, better. And we're pretty diversified across a variety of market segments, but we're best known for our insurance for technology companies business. And there we're very fast growing. I mean, relatively about 99% of our revenue right now comes from our insurance business, so it's doing very well. As an insurance company, float is very important, and it's very important to put that in fixed income ETFs. On the surplus side, typically people will invest some amount into equities. Thematics are very common. Buffers are very common. This downside protection is important. And when we were looking at the amount of capital that we were going to have to allocate to reserves about a little under a year ago, and we forward projected it, it was in the hundreds of millions of dollars. And we looked at the fees that we would have been paying ourselves if we were just buying what was on the market. For example, if we were buying buffers, if we were buying some of the fixed income products that are applicable for insurance. And we thought that those expense ratios were very, very high, and that we weren't getting serviced by buying what was on the open market that would have matched what we would expect for the amount of money that we'd be paying. So originally we put like one guy and one intern on figuring out how to file ETFs. We launched 2 starting in late December or early January, I think. And since then, it's become a real and rigorous operation where, much like our insurance business, our mission is to make insurance faster, better, cheaper. We want to do the exact same thing on asset management. And maybe we're not going to be necessarily competing with active managers that are providing more premium service or advising you on where to allocate your capital. Our mission is rather to just lower fees across the board, essentially re-rate the fee structure for the entire ETF industry, which actually could benefit active managers, because many managers might choose to allocate capital to our ETFs as part of their strategy for their clients. And in general, we'd really like to repeat the same thing that we've done in insurance to the ETF space in general, and to broader financial infrastructure products. And we feel pretty confident that we're going to be able to do that on it, and we're very patient. On insurance, now I guess we're relatively well known, but for the first 2 years of our company, we didn't have a website. We had to raise over $100 million pre-revenue in order to get our insurance products off the ground. And on the ETF side of things, we haven't even officially launched that yet. We've been out under a year, but already by the end of the year, I feel pretty confident that we're going to have more ETFs than the next largest issuer, more than anyone else. And I think that if you look at our rate of growth, right now we're at just shy of $1 billion in AUM, but every couple of months that's tended to double. And I think that we'll keep that up just by offering good products, by giving investors a lot of choices at typically the lowest fees in whatever category that we care about.
All right, so it's we're going to delve more into that later on in that story for the podcast. But John, I'm going to give the last word to you here. You mentioned a number of different opportunities that you're looking at right now. As you look at the way that the ETF business is evolving and has evolved over the course of the past, say, like 3 or 5 years, since kind of like the depths of the pandemic, that we kind of normalized things, Where exactly do you think kind of this fund management business is going to gravitate a little bit more towards? Is it a pendulum that has gone from passive to active and maybe swings a little bit back towards the passive side of things eventually? Or do you feel as though this real thematic and active push is something that it really is going to be the primary driver of the ETF business, not just in AUM, but also issues over the course of the next, say, 3 to 5 years?
So I'll give you a couple of different answers. One is that I do think that the filing process has gotten quicker. So Nico talked about that. Two, I mean, we're living through historic periods of how crowded and concentrated the S&P is. So 7 stocks make up 40%. If you go back 100 years, we're at 100-year wides, right? So it is a time for active managers. It makes sense to tilt away. So the market really started rotating like last summer. And so since last summer, you are seeing, value-centric strategies outperforming, and active managers are doing better. They just don't do well in like the S&P 500. So everyone obsesses over like the Spiva report, but that is, large cap U.S. equities, which is a highly efficient market. If you start going to other areas, mid cap, small cap, active fixed income, emerging markets overseas, you do see active managers outperforming. I can tell you at Astoria, like we are having an exceptionally banner year in terms of like how we're doing versus our benchmark. And so there's a couple of reasons for that. One is that idiosyncratic risk is high, dispersion's high. So when you have a lot more volatility, you can have more time for alpha, right? So we're seeing that on our quantitative active equity suite. And then just, it is a very strong U.S. economy, right? So yields are rising, manufacturing data is strong. We're living through like an earnings bonanza, right? If you look at earnings growth. So if you can't outperform as an active manager now, you will never. So I just think they have a little bit of like runway, like this year, next year. And so let's see if they deliver. But in the index and passive is crowded. Nico's firm's trying to, compete, and that's a tough place to compete. So we're trying to like compete in like the active space where we feel like, and we are competing and having strong results versus our peers.
All right, we'll have to revisit this conversation X months or quarters down the line to see whether or not that story's played out. John Davi at Astoria, thank you very much. Nico Lacqua, please, you're going to stick around as well for the podcast. You can catch that, and by the way, all of our other content over at CNBC.com, at etfedge.cnbc.com. Thanks for watching, and we'll see you next week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from top industry experts. Sign up now at cnbc.com/ETF Edge newsletter.